4 houses, 2 states, $3,200 a month in my pocket, and 2 of them are completely paid off. Don't believe me? Let me show you. Every landlord told me Section 8 tenants would trash my property and the government would hold my rent hostage. I used to believe them until I found one simple trick that flips the entire power dynamic in your favor. By the end of this video, I'll show you my exact numbers, the voucher percentage most landlords get wrong, and the one photo habit that ended almost every maintenance dispute I used to have. The part about the 40% voucher is the one most people miss. So stick around. Everyone told me Section 8 tenants would trash my house. Everyone told me the government would hold my rent hostage. Everyone told me I did be dealing with broken windows, missing smoke detectors, and endless phone calls. They were not wrong. But here's nobody tells you. I own 4 Section 8 properties right now. 2 of them are completely paid off, and the cash flow is $1,000 a month each. The other 2 put $600 straight in my pocket, and every single month, on the last day of the month, before the month even begins, the government wires me the money. I did not feel like this about Section 8. In fact, before COVID, I used to hate it. So let me tell you exactly what changed, what still drives me crazy about it, and the real numbers behind the properties. 2 in Alexandria, Virginia, and 2 in Charlotte here in North Carolina. So you can decide for yourself if the strategy is for you or not. Hey everyone, if you don't know me or are new to my channel, my name is Vikram Chopra. I was an investment banker turned broker in the greater Charlotte metropolitan area, where I invest and assist other investors reach their financial goals through real estate investing. Before I show you the numbers, I need to be honest with you about where I started. Because if I only told you the good stuff, you would think I'm selling you something. Before COVID, I already had Section 8 tenants, and it was rough. Not because the tenants were bad people, but because the constant maintenance battles. Something would break in the house, the tenant would call me, I did go fix it. 2 weeks later, something else. And here's the part that really got under my skin. Sometimes it wasn't even normal wear and tear. The tenant would break something themselves, then call and act like it happened on its own. And if I did not respond fast enough, they did call the city, and when the city gets a complaint, they can hold your rent until the repairs are made. So picture this, you are already paying to fix something you didn't break, and the government is still holding on to your check while you do it. This was my relationship with Section 8 before 2020. I remember one specific case. A tenant called me and said that the back door lock was broken and they couldn't secure the house. I go out there and it's obvious the lock had been forced. Somebody had jammed it open at some point, but I had no way to prove it. No pictures from move-in, no records of the original condition. So I just paid for it, fixed it, and moved on. That happened over and over, not because these were bad people, but because I had zero documentation and zero leverage. Every dispute defaulted to me, the landlord, being wrong until I could prove otherwise, and I usually couldn't. Then COVID hit, and something interesting happened, not with my Section 8 tenants, but with my market rate tenants. Rent was due, people had jobs, people had money, and they didn't just pay because they knew I could not evict them. That means there was nothing I could do about it. Meanwhile, my Section 8 portions, even during the most chaotic economic moment in modern history, landed in my account on the last day of the previous month. Every single time, like a clockwork. That's when it clicked me. The government is a way more reliable business partner than half the tenants I was trusting to pay me directly. By the way, if you're a beginner or an investor and are looking for guidance on how to get started in real estate investing, feel free to book a 20-minute phone call with me. Link below in the description. So I didn't get just lucky after that. I changed how I operate completely. And this is the part I really want you to take notes on, because this is what took me from hating Section 8 to running 4 profitable doors on it. First, I fixed each house once, and I mean it, really fixed it. Not just band-aid repairs. Full fix, top to bottom. Second, I documented everything. I took pictures of every room, every fixture, every appliance in move-in ready condition. Then I put these same photos on public listing sites like Zillow and other rental platforms. That wasn't just for marketing. That became my proof. Here's why it mattered. The next time a tenant called and said, "Hey, this is broken," I pulled up the Zillow listing photos from the move-in day. If that thing was working and undamaged in the photo and now it's broken, that's not on me. That is the tenant's damage. damaged, and by lease terms, that's their responsibility to fix it or pay for it. It completely flipped the power dynamic. I went from constantly being on the defensive to having documented proof of every single unit. I actually had a tenant push back hard on this once, insisted the stove had always been like that. I pulled up the exact listing photo, timestamped, showing a clean working stove from the day they moved in. Conversation was over in 30 seconds. No arguments, no back and forth, no me eating the repair cost. That single habit, photograph everything, publish it publicly, let the internet timestamp it for you, has probably saved me thousands of dollars across 4 properties.
The first thing I want to do is show you how to push back, and not just push back pointlessly. We need to have some documentation to support our claim. Let me show you my documentation. The way I do it is from the housing, saying, hey Vikram, I hope you're doing well, and then these are all the problems that they've listed out. And this is on March 6th. This house was rented in 2022, so 4 years have gone by, and I receive an email saying, Vikram, these are all the problems that are there in the house and I need to get it fixed. We would appreciate it if this could be repaired at your earliest convenience. So that means I have to pay for this, but I'm not going to pay for this. I already have everything documented. These are before and after pictures. The before is obviously the Zillow link, because all the pictures are there in Zillow, and then below is the response. I'm attaching the lease P12 number 20 lines 4 and 5. This is where in the lease it's stated that if there's something that's damaged by the tenant, then the tenant has to pay for it. And if you look at the before pictures, I'm claiming it here also. Bedroom near bathroom does not close properly. I say yes, it does. It has 2 metal hooks hanging from the top. Once you remove the hooks, they'll be fine. Let's look at the second issue. The plate be secured, the doorknob installed incorrectly. I said the striker plate and doorknob have been damaged by the tenant. When the house was rented, the striker plate and the doorknobs were fine. You can see it in the Zillow listing, image 25. Let's go down. Kitchen light has been altered by the tenant. Multiple images can be found in the listing below. So stuff like that. This is what I did, and eventually, you know what, they gave up. They said, okay, fine, because these are all due to our tenants, we will make sure that these repairs are made by us and not by you, and so I don't have to pay money for it. So that's important.
Third, and this is the biggest shift, I got a lot more careful about who I approved. I stated specifically looking for Section 8 tenants who were also employed, not just living entirely off the voucher, but actually working in a job on top of it. In my experience, tenants who are working tend to care more about where they are living. It's not just a universal rule, but it's true across all my properties. I made a video here that you can watch on how to keep tenants in for a long time. Let's go to my computer and let's get into the actual numbers, because I know that why most of you clicked on this video.
Let me quickly show you the Section 8 deposits that I get. This is the first one. It's $1,300 a month. As you can see, I had a tenant leave somewhere in April, so that's why it went down. But this is the first one. This is the second one. As you can see, there's a constant deposit of $705 starting from January 1st. Before that it was $693. There was an increase in the rent amount. This is the third one. This is from Alexandria. As you can see, there's a constant deposit of $1095. This rent schedule changed sometime in March. The housing voucher picked up a little bit more slack and the tenant had to pay a little less. This is what the tenant pays every month, at least this much. These other are the money that she owes, but every month she pays me this much. Add this number to that and you'll have the complete month's rent. And there's more to it. I wanted to show you the breakup. Let's go to an Excel that I prepared for you guys. These are the 2 properties that I own in Alexandria, and these are the ones that I own in Charlotte. The first 2 are paid off over here. When I bought them, they were not really expensive, but now they have become very expensive. The HOAs are significant because the HOAs include utilities and other bills. The taxes and insurance are significant as well, and the rent is on the higher side. So there's a net cash flow of $1,000 at least a month from each one of these. And the ones that I have in Charlotte, they still have a mortgage, but the HOAs are not as expensive because the utilities are paid by the tenants and the rents are also not that high. But it does break the 1% barrier, because 1% of the purchase price would be $700 and instead I'm getting $1,300. It's almost close to 2%. So these investments are good. Unfortunately, both of these are in C- neighborhoods, and after some time when the market picks up, I will find a way to sell them out, because I do not want to keep, eventually my goal is not to keep any property that is in the C- neighborhood. Instead, I'm looking for something that's B minus or C plus. That's about it. Thanks.
Now, here's something important about the Virginia property specifically. Rent in that area is actually higher than what Section 8 pays me. I'm not getting a premium from the voucher program in Virginia. I am intentionally leaving some money on the table for the stability and consistency I get in return. In Charlotte, the Section 8 rent is basically at par with market rent. So here, I'm not sacrificing anything at all. I'm getting market rate and government-backed reliability. And I want you to notice something about these two markets because it is actually a strategy in itself. Virginia and North Carolina are playing two completely different roles in my portfolio. The Virginia properties are paid off, higher purchase price, and I'm intentionally keeping it slightly lower rent than market in exchange for stability and consistency. Those are my sleep at night assets. The Charlotte properties were cheaper to acquire, rent at full market value even with the voucher, and that $600 a month on a $77,000 to $82,000 purchase price is genuinely strong cash on cash return. So one state is doing the job of preserving capital and the other is doing the job of pure cash flow. That is not an accident. That is how I think about every new market I get into now. So across all four properties, there's a $3,200 in month net cash flow from an initial combination purchase price of $414,000 with two of the four properties paid off fully. And I want to be clear, these are not hypothetical numbers from a course or a webinar. These are my actual doors, my actual tenants, my actual bank deposits. Now, I'm not going to sit here and tell you that Section 8 is all upside, because if I did, you'd stop trusting everything else I just told you. The single biggest issue every Section 8 landlord deals with is maintenance, specifically around the inspections. Section 8 requires a full inspection before a tenant moves in and then re-inspections periodically after that. And the standards are strict. For example, every window in the house has to open. That sounds simple, but most investment properties are 20-30 years behind on maintenance. Old windows get painted shut, wrapped stuck. That's an automatic fail. Smoke and carbon monoxide detectors are another big one. I have personally seen tenants remove the batteries or remove the whole detector because they did not want it to deal with the beeping sound when the battery gets low. But when the inspector shows up for a re-inspection, if that detector isn't there and functional, you fail. No exceptions. So that's now a maintenance item. I proactively check before every single inspection, window on every property. And here's the part that really trips up people. You don't get to pick when the inspection happens. It's usually scheduled with some notice. But if you fail, you are on the clock to fix whatever the issue was and get a re-inspection done before the voucher payment gets held up. So this isn't a fix it whenever situation. A failed inspection can directly delay your rent. That's why I now do a pre-inspection walkthrough myself days before the actual inspector shows up, checking every window, checking every detector, checking every outlet, anything HQS standards are strict about. So I'm never caught off guard. Here's the silver lining though, and this is something a lot of new Section 8 investors don't realize. Section 8 tenants are genuinely terrified of losing their voucher. If they get evicted for violating the lease, they don't just lose that apartment, they can lose their spot in the entire program. That fear is actually one of the best tools you have as a landlord. It means once you set clear expectations and back them up with documentation, most tenants fall in line fast because the alternative is losing housing assistance altogether. That's why if you have questions, doubts, concerns, go ahead and book that free 20-minute call with me. We can discuss your situation together. Here's something I wish someone had told me when I started, and it is probably the single most valuable insight in this whole video. Not all Section 8 vouchers are the same. I have seen vouchers where the government covers 100% of the rent, all the way down to vouchers where the government only covers about 40% and the tenant pays the rest out of their pocket. I personally now prefer tenants sitting around that 40% government paid range. Here's why. If the government is only covering 40%, that means the tenant is working and covering the other 60% themselves. That tells me two things. One, they are employed and they have their own income, which in my experience correlates with taking better care of the property. Two, if the tenant ever loses their job, the voucher formula adjusts and the government picks up the rent until they're employed again. So I'm protected on both ends. Good tenant behavior when they're working and an income adjusted safety net if they're not. I've actually seen this play out directly. A tenant on one of my properties lost the job for a few months. Instead of falling behind or me facing a vacancy while they figured things out, their voucher percentage simply adjusted upward and the government temporarily covered more of the rent until they got back on their feet. My cash flow never skipped a beat. Try getting that kind of built-in safety net from a market rate tenant. And one more number worth mentioning. Section 8 tenants, in my experience, stay much longer than the market rate tenants. they are not out there shopping for a better deal every year like a lot of market tenants, because moving means requalifying, reinspection, and risking a gap in their assistance. Long-term tenancy is honestly where the real profit shows up in this business. Turnover is one of the biggest cash flow killers a landlord faces. Every vacancy costs you lost rent, cleaning, repairs, and marketing. A tenant who stays for 5 years straight is worth more to your bottom line than 2 tenants who each stay 2.5 years. So, to wrap this up, 4 properties, 2 states, $3,200 a month in combined cash flow, 2 of them completely paid off. Is Section 8 investing perfect? No. You are going to deal with stricter inspections. You're going to deal with maintenance headaches most other landlords don't think about. And you need a system, not luck, to make it work. But if you build that system, document everything, screen for tenants who are also working, understand the voucher percentages, and stay ahead of the inspection requirements, this can be one of the most stable, most overlooked strategies in real estate investing. If this kind of real number breakdown is useful to you, subscribe, comment, like the video. I'm going to keep breaking down my actual deals, the good and the bad, so that you can build a portfolio without learning these lessons the expensive way. Next up, I'm planning to show you where's my cash flow and updates on the housing market. So if either of those sounds useful, subscribing is the only way you won't miss them out. So until next time, this is Vikram signing off. Good luck, goodbye, and go start putting Section 8 tenants in your rentals. Let's start a revolution. Long live freedom. Freedom from poverty, freedom from bad bosses, freedom from anything that stops us from building our business. Thanks for watching.